So today was an absolutely brutal day in the market. So instead of a long drawn out intro, here's Trump explaining money laundering.
Now you know you need to launder your money, right?
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks fell sharply on Friday as Wall Street grappled with Trump's escalating trade war and weighed signs of reinvigorated inflation pressures as consumer sentiment plummets. 83% of S&P 500 companies were in the red today, an average decline of 2%, a very messy day under the surface, and we saw defensive areas of the market that weren't really exposed to tariffs outperformed. For example, utilities, not really going to feel the brunt of tariffs per se. They were broadly green. Certain sectors were green, stuff like AT&T and Verizon in the communications sector. We saw health insurers as well as financial insurance companies, look at PGR, outperform relative to the S&P 500, and certain healthcare names, stuff like Lilly, Johnson & Johnson, AbbVie, Merck, those companies, these health tech companies right here, the big boys in the health space, outperforming relatively speaking. Other than that, it was a brutal day across the board. Apple fell, Nvidia, AVGO hardware, software, Microsoft, Google, Meta, Oracle, Netflix. It was a very brutal day across the board, across the consumer discretionary space, in consumer services, industrials. All sectors, including financials, really took it on the chin today. The only green sector was utilities, gaining 1%. Gold also rallied 0.75%, eclipsing the $3,100 mark. Absolutely insane run in the market, buying safe havens because of policy uncertainty and trade uncertainty. Every other sector was red, led by selling here in the discretionary space, communications and technology, with the S&P 500 falling just over 2%. And we felt the pain in small caps, mid caps, large caps, value, core, growth. The only outperformers was mid cap value, large cap value, but they were still red in excess of 1%. So it really goes to show the selling we saw in the broad market. Nowhere was safe, and there was really just a rotation from risk assets into safe havens. We had a very bumpy week. And what compounded the selling today was actually some of the economic data we got. Now, if you actually look here, core PCE came in hotter than expected, 0.4 versus the 0.3 consensus. Now, the headline figure came in exactly in line, 0.3 versus 0.3, and the year-over-year figure of 2.5% came in line. So the headline figure, good. The core figure, not that good. So a little bit of inflationary pressures when you exclude gas and food. Now, we also got the personal income outlays. Now, personal income increased a lot, 0.8 versus 0.4. So the consumer keeps outperforming the actual growth of inflation. That's very positive. But what we saw was personal spending took a hit right here, 0.4 versus 0.5 against the expectation. So when you have a higher personal income numbers, right, versus a lower personal spending number, you're going to see the savings rate increase. And, Americans are probably just saving part of their income right now just because of the uncertainty, tariffs, and everything surrounding this administration. So this just alludes to the consumer pulling back. And that is why we actually saw a lot of the selling here today. Also, Michigan consumer sentiment missed expectations as well, but this is a highly politicized sentiment survey, in my opinion. Now, looking at everything, diving into the personal income outlay report, nominal consumer spending actually looked fine. It's just that some of it got eaten away by inflation. The consumer is pulling back. Food services inside this print was a little soft due to weather-related activities, but, income remains robust, spending not so much. The savings rate increased. All in all, you got to take this report for what it was, and slightly hotter than expected inflation, the consumer pulling a bit back. It doesn't look good, especially because Trump is imposing 25% tariffs on US imports, and this is ultimately what caused the volatility this week. He's expecting to raise $100 billion from all of this, and automakers, especially those that produce outside of the US, are in absolute free fall here in the markets. We'll talk about it on the charts. Now, Trump came out, warned US automakers not to raise prices in response to tariffs. Now, I don't like this rhetoric from Trump at all. This is low-key communist stuff right here. You got to let the free market do what it's intended to do. And if it needs to raise prices, let it do so, right? You can't go ahead and impose price controls on automakers where you just raise tariffs by 25%. You simply can't do that. GM, Ford operate on 5% margins. If they can't raise prices, they are going to go under. You don't want that. You don't want factories going under, especially for all of the new factory builds coming into the US. So Trump, let the market do what it's doing. Don't get into this communist authoritarian regime where you're going to implement price controls or expect automakers not to raise prices when tariffs are being implemented. Let the free market do its thing. However, Trump has proposed a new tax policy that allows individuals purchasing vehicles manufactured in the US to deduct the interest payment on their auto loans from their federal income tax. This is probably just to help the underlying consumer as these tariffs do get implemented. Donald Trump also came out and said he just finished speaking with Prime Minister Mark Carney of Canada. It was extremely productive. They agreed on many things and will be meeting immediately after Canada's upcoming election to work on elements of politics, business, and other factors that will end up being great for both the United States of America and Canada. And we may see some of this on the weekend where Trump is talking to these countries and we get some good news. However, we're also going to get a lot of these countries retaliate with regards to these auto tariffs, especially in Europe, where a huge majority of cars are sold into the US. So it's going to be a very, very volatile weekend. Anything can happen, guys. We could be up on Monday by 2%. We can be down by 2%. It all depends on the news flow this weekend. So I'm going to be doing a ton of live streams looking at all of the news. So go ahead, subscribe so you don't miss the live streams. I'm going to do multiple of them this weekend discussing tariffs and everything in between. We're also going to talk about Lululemon's earnings. Now, they were down 15% today after the CEO, Calvin McDonald, said consumers are beginning to spend less in response to increased fears about the US economy. The stock actually beat the quarterly earnings, but produced a soft guidance owing to weak store traffic and looming tariffs. The market did not like this. I actually spoke about this on FinFluential Media. We spoke about Lululemon and how I still think the stock is a little bit expensive, but if it keeps falling, it may actually be getting to an attractive place where I may look to buy, but it still needs to fall a little bit further. Nonetheless, Nike, Lululemon, Deckers Outdoors, all of these stocks, consumer stocks, have really taken it on the chin this year. Now, CoreWeave IPO'd officially today. It actually opened at $40 and closed at $40. So it had quite the round trip. We saw a pullback here in the early hours, a rally into positive territory. And this is the first real test of the AI trade. That's because Nvidia backed this company. And CoreWeave's fate relies in large part on the sustained success of generative AI, which CoreWeave even itself said, we don't know where the market is going with AI, but they are set to profit from it if the trade plans out the way they expect. Now, guys, the thing with CoreWeave is that we're now going to get a real gauge every single quarter of where AI sentiment is in the market. That is Nvidia to a degree, but a lot of the time, these massive companies are just buying their chips because they don't want to get left behind. Whereas CoreWeave, right, the increase in used services will tell us where the AI trade is going. This is probably going to be more of a clear real-time barometer for the AI trade than Nvidia. And I'm all here for it. I'm going to keep a close eye on this, and we're going to talk about this stock in the live streams as well. Now, for everything we saw today, guys, 5,000 decliners, insane. 1,100 advances, outflows in the New York Stock Exchange and the NASDAQ 100. The majority of the outflows happening in the first hour. Then we kind of traded sideways for most of these exchanges, and market momentum is sour. Shorter term, longer term, medium term moving average is well below the 50% line. And the brutal selling actually continues here in extended hours. The IWM, the RSP, Qs, and the S&P 500 all falling in extended hours. That's on top of a 2% decline for the S&P 500, 2.6 for the NAS, 2% for the IWM, the RSP marginally outperforming, but just a brutal day for risk assets. I mean, value outperformed growth, but still both down 1.48 and 2.48% respectively. We saw yields fell in response to the weaker economic environment as well as the weaker economic data. The dollar also fell, yields gained, so there was definitely a rotation from risk assets, equities into bonds, and we also saw Bitcoin falling 3.85%. Bitcoin is a real barometer for risk sentiment, and then gold gained again because of that economic uncertainty. Gold is a safe haven, very much like treasuries. So gold rallying, treasuries rallying really tells you that the market was just risk off today. And in yesterday's video, we said this would happen. We said if we get a hotter than expected PCE print, we are going to make lower lows and slice right through all of these levels. We're officially back in negative gamma. We're still above the low we put in right here. But next week, this is going to be the absolute zone that we test. I think if we fall below this level right here, things can get ugly, especially as we approach this low, but we'll take it one day at a time. Right now, the 54.85 and 55.20 level are the key levels we want to watch, especially after the brutal day we had today. Look at this candle, right? We only gapped down marginally and then we just made lower lows, lower highs into the close, led by selling across the board, finishing at the low of the day. Some very, very minor selling. And what we got today was a hot PCE and risk off into the weekend. I think on Monday, we're probably going to go ahead and test these waters right here. If we get negative or no news flow from this administration on the weekend, if we get negative or just no news at all from any countries or the Trump administration, we are going to go ahead and test these lows. If we get positive news flow on Monday, we probably are going to go ahead and test the gamma flip. So that's what we're expecting. And that is why you need to get on the live streams when I do them, because we are going to dissect all the news every single day on Saturday, Sunday, and Monday. All 3 days, we're going to dissect the news to see what the market is doing. So pretty much, look, if we continue to see negative sentiment and retaliation, we are 100% going to go and test these lows, maybe even the put support level. But if we get positive news flow into this weekend, right, then I do think we're probably going to make a move from here, put in a higher low, and then retest the gamma flip, and then go from there, either down or up. So that is the game plan on Monday, right? Instead of trying to predict what's going to happen, we're just going to wait. Let the news flow in this weekend, and then we'll go ahead and make a determination. Either way, it's a very binary trade. Negative news or no news means we go lower. If we get positive news, we're going to go ahead and test this gamma flip zone, but we are in negative gamma, and you know what that means. Dealers buy into strength, sell into weakness, and you have very volatile price action. However, one positive, the gamma flip zones did not move. And what's very interesting about this, we actually did point this out at the start of the week. We said the gamma flip zones did not move up, so we do want to expect downside into the end of the week, and that's exactly what we got, compounded by a hotter than expected inflation print. And we actually called this week about as good as we could have. You know, we said we're going to expect weakness, expect churn, expect resistance here at the core resistance. And that's exactly what we got. We got the same in the NASDAQ 100. These levels work like a charm. On Monday, Tuesday, we said there's a little bit of upside into the NASDAQ 100. And then we actually saw a brutal pullback. And we are pretty much at the lows of this week. I mean, if we get negative news, we could slip right through these lows in the NASDAQ 100, make a lower low, and then that could definitely open the levels right here and right here. But instead of trying to predict what's going to happen, we're just going to take it as it is. Beware of the news flow as it pertains to this weekend: tariffs, trade policy, Donald Trump, Europe, and Canada. Looking at the RTY, guys, down 2% today. Brutal price action, looking like a lower low is being put in right here. In negative gamma, we closed below the put support, which means it's probably going to move lower into next week. I mean, if we don't hold this level right here, we probably go straight to these lows right here. And if we actually just measure where that is, we're looking anywhere from 1900 to 1950. So it's do or die for the bulls on the RTY for small caps. Let's quickly have a look at the 10-year yield. It does look like we're putting in a lower high relative to these highs right here. That is positive for yields, for rates, for the consumer. And then the dollar at the 103 level continues to move down. I think we actually go ahead and probably going to test this level again. I think we're going to see yield and the dollar move lower, especially as the tariff and trade policy evolve. Let's actually go ahead and talk about Bitcoin, because Bitcoin is doing exactly what we said it would do. So go on TradingView, click the indicator panel, search FinFluential Global M2. You're going to get this indicator right here, right? And then you actually want to go ahead and offset the indicator to 107 days. Okay. And then change the Bitcoin indicator to a line chart. And in doing that, what you're going to see is that Bitcoin follows the M2 money supply lag by 107 days very, very closely. Now, it's not a one-to-one relationship, but you can see when we moved up right here, so too the Bitcoin. When we traded sideways in this very, very wide range, so too did Bitcoin. Bitcoin is this blue line right here. And then when we made our next move up, so too did Bitcoin. And when we made our next move down, so too did Bitcoin. What we are expecting now is a move off the lows right here and then a pullback. That's exactly what Bitcoin is doing right now. And we expect the pullback to materialize to about the lows we put in at about early March. Then we do expect to trade sideways, as you can see right here, and then make a move to the upside. That's exactly what we're thinking is going to happen with Bitcoin. So for Bitcoin, do expect a little bit more downside into next week. We trade sideways and then we'll make a huge move to the upside from here. And this move is expected to happen around about starting the 5th of May, but the lows can be put in around about 6th April, mid-April. So anywhere from about mid-April right to about late April, expect a bottom to form in Bitcoin and then we'll rocket up. This is also when we are going to see strength in the overall equity markets. Now, do remember that when money supply flows into Bitcoin, it actually flows into all assets, all risk assets. So we are in a time and place where we are going to see the liquidity regime dry up, relatively speaking, and then we're getting ready to make our next move. All of this momentum we're seeing is completely healthy and completely normal in the grand scheme of things. Now, guys, we have some breaking news as it evolves right now. As I'm literally recording this video, Donald Trump just came out and said he is willing to make deals on tariffs as it happened. We're calling it first here. He's planning to make deals on averting auto tariffs that would come later. I think we're going to get more of the same this weekend. He speaks a big game and then the deals happen behind the hood. I think we're going to see some positive developments, but we'll take it day by day. But this is a pretty good step. Now, the market not reacting super positively. We're still down here, but we'll see how this goes. You know, it takes a while for sentiment to make its way into the markets, and there's also very low liquidity here in the extended hours. But very, very slightly positive news. We want to see more of the same, and we want to see from Canada, from Europe, from Mexico, from these countries. We want to see what they have to say and what their response is. But yeah, very, very crazy news as it happens. You heard it here first on FinFluential television. So go ahead, subscribe, guys. Subscribe to both my channels because I will always bring you the most up-to-date and breaking news. But I digress, and let's just quickly go ahead and recap what to expect for the S&P 500. If we get positive news flow, right, we're going to look for potentially a resistance zone to form here at the core resistance, at the gamma flip, right at the 56.53. If we get negative news and bad retaliation, we want to potentially have the market take us back to these lows, and then we'll go from there. So that is the trade we're looking for on Monday. Don't try to predict what's going to happen. Just react to the market in aggregate. We'll see if the positive news flow outweighs the negative news flow. But all in all, what Monday's trade is going to come down to is the rhetoric we get here on the weekend. And then stocks in the market will pretty much trade on that. But nonetheless, guys, you know the game plan. Sit tight. It's going to be a crazy volatile weekend. So stay tuned, subscribe, and you won't miss a beat. And diving into sentiment, this is CNN's Fear and Greed Index. And guys, despite all of the price action we've seen towards the back end of this week, we are still here in the fear zone. We have moved up from the extreme fear where we got to lows as low as 15. So sentiment has improved a little bit. We have seen a little bit of market breadth improve, and markets are kind of hanging in there. We're not quite at the lows we were sort of mid last week, which was near that 10% pullback from peak to trough. So we have seen a little bit improvement in the market. We have started to see certain markets bottom out. And as a result, we have seen fear abate a little bit. And this is actually really good for those who bought the dip. What you really want to do now in this position is potentially add to the names and stocks you like, as well as just be patient as the market continues to do what it's doing. And for those of you that are long, you want to be looking at the fundamentals, and the fundamentals are still pretty good. Right now on a forward 12-month basis, S&P 500 earnings is up 1.3%. The S&P 500 is down 5.3% year to date. That means all of this move we've seen here in the S&P 500 has resulted from a 6.6% contraction in the overall multiple. Nonetheless, stocks are pulling back, but not for any earnings or fundamental reason. They're mostly doing it on the back of technicals and what they're hearing from the White House. And when we look at S&P 500 year-end forecasts, we still have upper end forecast of 70,000. of 7,100 a year from Oppenheimer, which would represent about 23% upside from where we are right now. The low end Stifle sees about a negative 1 to 2% downside from where we are right now, but the majority of banks actually see us rallying from where we currently are and actually finishing higher than the all-time highs we saw in the middle of Feb. That's largely positive, and you largely want to stay the course, especially when you look at the earnings picture. S&P 500 earnings is expected to grow 11% for the full year 2025. Yes, that is down from the 14% level we saw at the start of the year. Nonetheless, we're still looking at double-digit earnings growth, which is mostly going to be held together by the back half of the year. Earnings growth in Q3, Q4 is looking for 12% and 11.4% respectively. And we're also seeing mid to high single-digit growth here in Q1 and Q2. Now, there is a risk to this market. If these estimates right here, Q1 and Q2, start to get revised lower to the downside as the year goes on, that's where things look really dicey for the markets. But what we really should be doing first is getting through Q1 earnings, see what the estimates are for Q2, and then we can decide on what to do next. But in the year and now, earnings estimates look really good. And when we look at the overall revision trend, 2025 is still tracking well above the median consensus EPS revision estimate going back to 1985. And we're actually kind of tracking in line with 2024. So even though we are seeing earnings revisions, nothing crazy is happening with regards to those revisions. In fact, we are doing what we historically normally do, and that's we do see revisions going into said earnings quarter, and we're still well above the median estimate when we look at the long run average. And with all of that in mind, I've sort of mapped out a game plan for the S&P 500 for this year. This is what I think we're going to do. I think we're sort of going to churn in this very, very wide range up until about October, August, potentially putting in a low around the June, July area, and then we'll probably go up and rip from there. I am expecting very bullish momentum in the second half of the year. It's going to be a back half loaded year. That's when the majority of gains are going to come. And I do see my end of year target at 6669. That's actually what I said it was at the start of this year. It hasn't changed. I still think we're going to resolve higher, but not without some volatility and churn. And also, you have to understand, if we continue to trade sideways in this range, right, this will just mean the multiple contracts as a fundamental of time, not because of price pulling back. And that just makes stocks cheaper in the long run and just means we do go higher into the end of the year. However, all of this is subject to change dependent on the macro, and I do reserve the right to change it, especially if the macro deteriorates. But in the year and now, we're simply not seeing that. GDP for the fourth quarter came in at 2.4%. The expectation was for 2.3%. So GDP looking really, really good. This is the contribution to percentage change in GDP if you guys want to go ahead and have a look at it. But something else that totally flew under the rug this week was the Red Book Index. This is essentially just a weekly aggregator of retail sales. It came in at 5.6% year over year. The 4-week average has pretty much been above the 5.6% range for most of this year so far. And this is telling us that despite what the soft data, stuff like the University of Michigan sentiment and the Conference Board consumer sentiment data is telling us, consumer spending is not taking a hit. This is the most recent week we have right now. Consumer spending still looking very robust and not even close to recessionary spending levels. However, tariffs will increase inflation, and this could be a little bit of a headwind for the rest of the year. Auto tariffs could add 0.25 percentage points to inflation. The US imported about $200 billion of cars and parts, excluding Canada and Mexico, over the last 12 months. And they saw a 25% tariff that would amount $50 billion in revenues, but it would remain short of the $100 billion a year mentioned at Trump's press conference. Considering that $50 billion is equivalent to 0.25% of consumer spending, a back-of-the-envelope calculation would yield about 25 basis points of upside to PCE inflation. Risk around our back-of-the-envelope estimate for inflation are both sides. On the one hand, we have not included imports from Canada and Mexico, which will eventually be subject to a partial tariff according to the announcement. Domestic producers might also increase their prices in response to increased demand. On the other hand, domestic firms might prefer to keep their prices flat to increase their market share. And we actually are starting to see the early signs of what price increases could look like BMW released their latest retail prices for some of their models, and look at the M2 right here. They see an increase of about $2,700. The current MSRP is $65,500. The new is going to be $68,200. So essentially, they're not putting the entire tariff onto the consumer. It looks like a BMW is actually going to eat the cost, the majority of that 25% tariff. In fact, BMW are looking to absorb 21% of the 25% tariff. So guys, these auto manufacturers, these car dealerships, if they're not being made in the US, you're going to see their margins get squeezed over the next couple of quarters. Very interesting data right here. I'm very interested to see how this all plans out. And I believe that as we move into the other model stuff like the M3, M4, M5, right, you should see this number gradually. Nonetheless, when it comes to imported high-ticket items, do expect the prices of those goods to be tangibly higher. Looking at data for the rest of the week, guys, we have a big data. It's going to culminate on Friday with non-farms, the unemployment rate, and average hourly earnings. We also have initial jobless claims on Thursday, ADP numbers on Wednesday, factory orders as well, JOLTS on Tuesday, and then the Dallas Fed manufacturing, as well as a couple of ISM PMIs, services and goods for the week. So a very big week of data. In terms of earnings next week, the only big name is Constellation Brands. That's about it. I can't see anything else that would actually matter to the market. So really, everything is going to be on the data and what we get from the administration with regards to tariffs and trade policy. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.